Welcome back, ladies and gentlemen. You're listening to another edition of DIY Money.
DIY Money.
Logan.
It feels like I haven't seen you in forever.
It's been forever.
A very long time.
I mean, in market years, I feel like it's been 2 to 3 years.
You've aged. I was looking at pictures of myself from like 6 months ago.
Oh, you've aged.
Gosh, yeah.
You've aged.
I got gray hair. It's not
aged.
good. Check out YouTube if you want to see.
Oh, yeah. He looks old. So how have you been?
I've been good. It's been crazy. It's been a very interesting few months. Of course, you picked the perfect time to retire.
Yes.
At all-time market highs. And then it's been chaos since then. So it's been wonderful.
Well, that said, we're cutting this on, June 15th or 16th, and we're back to highs in a matter of, days. But, the volatility that we've seen in the marketplace has been fascinating, for
At the same time, having things like SpaceX that have thrown all monkey wrenches into things.
Worthy to give an update on that because we did a special Back to the Classroom last week. Allie and I did. I thought it was good. Well, it just might have aired recently, but by the time this comes out, it will be a couple weeks. But at the time that we're cutting this, I think it's important to note the stock came public at $135 per share. It was right in the middle of sort of the range that we had discussed. However, and I thought this was really fascinating, it only opened at 150.
Right.
I thought that was interesting. I thought because of the demand of the book, it would be opening quite a bit higher. It closed, I think, that day at 159, 160 or something like that. For all intents and purposes, it was a very positive, not crazy one way or the other, well-received IPO. The next few days, the stock ran considerably. I think ultimately people were like, wait, I can get this close to the opening print and so forth. Ran up to 220 or 230 or something like that. And then, subsequently has come back. I want to preface both the article that we wrote and the podcast. I suspect there'll be this, back and forth with demand because of the addition to the NASDAQ 100, which is very unique. This is not a normal thing.
Yeah.
And so there's going to be this demand. But if I'm not mistaken, lockups start to expire in August or so.
That's right.
Right around the corner.
Yeah.
So I would suspect we would see some selling pressure into the summer and into the fall. I told on the podcast, I said, I'm not going to be a buyer. And then when it was coming out, I thought, I'm going to buy one share. Like, I'm going to put in a limit order for one share because that's what you had to do. So I got my one share. And then on the pullback today, I bought a little bit more. In full disclosure. Now, not a big position. Like, I want to watch it. I'm an Elon fan. I'm a SpaceX fan. There is no one who knows whether valuation is justified here. None at all. Nobody knows that. But anyways, I thought it'd be good to give a little bit of an update.
No, I like it. I think it's fascinating. And no one knows because everything is a bet on the expectations of what this company can do. Like when we saw it go over 210 earlier this week, we basically had it go over the market cap of Amazon and then just briefly over the market cap of Microsoft. That's kind of crazy, right? Like, that's unbelievable. These companies that have very long track records continue to build revenue, but it's the expectation and the forecast for the future that's the exciting thing for the markets right now, and that's what all these investors are trying to bet on for the future. I think it's going to go through a lot of ups and downs. I don't think you're going to see normal days in that stock. I mean, it's gone up to basically the highs at 210, and now it's down like 14, 15% from there when we're cutting this. Who knows where it'll be when this episode actually comes out, but it will be exciting to watch. I mean, it's one that I watch every day, although we're not buying it actively. It's one that I'm watching constantly.
Yeah, it'll be interesting. All right, housekeeping odds and ends. The 1,000th episode is coming up, and we have heard that actually it will air on December 28th.
Awesome.
It will be the last episode of 2026, the 1,000th episode, and if you've not heard yet, we're giving $1,000 away. So send us those questions, audio question, podcast at DIYmoney.org. Put it in the subject line or somewhere in the body of the email that this is your 1,000th episode question, and we'll put it in the queue. We're going to listen to them all. I saw that those are filling up. I looked at that the other day. I'm pretty excited about that. At full disclosure, I've not listened to a single one yet. We'll select that, and then we will send that person $1,000 for that entry, and if we air it on the show.
It's exciting.
If you send multiples, that's fine, but we'll only use one we won't randomly figure it. We'll pick the one we think has the best shot. The other ones we'll put in the queue for the regular program. If you've not signed up for DIY Daily, that's the daily newsletter, more market focused. So if you're not interested in market stuff, probably not for you. Comes out every day. I made a mistake like 2 weeks ago. I was like, it comes out every day at 5:45. And then I got back from Europe. And 5:45 is early for the retired guy back from Europe. So it might come out 6:30-ish. I don't know, somewhere around there. And then hit us up on the socials, DIY Money Podcast. Lots of stuff going on there. Brief break for our sponsors. Okay. Anything else you want to share? I feel like I've not gotten much update for you. Oh, yeah?
Sure.
Okay. Mm-hmm. All right. We got a great question today. It's a good one from Willie. Willie, what do you got?
Hey guys, Willie from Minnesota here. Loving the podcast. I have a question about moving investments between account types. Basically, I have a app that does the roundups, and then that gets kind of invested in stocks and bonds. And then I'm looking at actually using that to rebuild our emergency fund. So I'm looking at moving a few $1,000s out of that into a more high yield savings account type account. And I'm wondering what like the tax consequences are, if there's a better way to do that. Thanks.
Okay, Willie, great question. Thank you for sending that in. I'll hit the brushstrokes and then let Logan go more into the particulars, but it sounds like you might have had an emergency, right? So what Willie's talking about is sort of, creating that financial moat we've talked about. It's one of the 7 steps of the DIY process, and he's talking about probably has the fast cash and has 3 months in emergency fund. For whatever reason, he used some of it, right? Makes sense. That's what it's there for. Now it's time to rebuild. So ideally, what I'd love to see is monthly margin rebuild that. But if you are anxious about it, and I understand that as well, and you're like, no, I just want to get it over there and I want to rebuild it, and then I want to establish the investment fund, then you're going to have to sell down some investments. It's going to be difficult because you're going to be subject to taxes if they've gained. Now, you mentioned stocks and bonds. So let's assume you actually have mutual fund index funds that are stocks and then maybe some bond funds. I would look at the bond funds, right? Because maybe those aren't performing as well, or maybe they even have some losses. You can sell some of those down. Hopefully there's no transaction fees, sweep the money over and do that. If you have target date funds, however, and you're getting your allocation through a target date fund, you're going to sell some, you're going to move it over. It's going to trigger some tax consequences that Logan can talk about briefly. But just going back, I don't think that's a terrible strategy. You do understand you're going to pay some taxes. Again, he'll talk about that. But ideally, what I'd like to see is, assuming you're following all the steps, magic's in the margin, you have monthly margin, I would like you to just say, look, we're going to, instead of doing this investing or maybe stop the roundup or whatever, we're going to fulfill the emergency bucket from the monthly margin. But again, if you get anxious about it, selling could be the only way. What say you, Logan?
Yeah, so it sounds like Willie's using something like an Acorns app or something like that that's taking additional money every single time he has a transaction, throwing it over in this and then buying. I've never used one of those personally. I don't know if you've ever used like Acorns or anything.
In theory, I would love it.
Sure.
Because I hate, that would make my life so much easier in my tracking of expenses, except when I did look into it, it's not like when you go to CVS and you spend, $1.97, it immediately is $2. So it's $1.97 and then 3 cents eventually. So it would be 2 entries. It would annoy me.
Not okay.
So it was not okay, and I didn't do it.
Got it.
Sorry.
Okay. So if you're doing that, you're buying in over time, you're dollar cost averaging effectively into this type of account. And it's basically a brokerage account, a bank account that you can invest in. So if you sell stocks or bonds and you have a gain, so if you bought for $100 over time over these 100 transactions, you bought $100 in and that grows to $150, you sell it, that's a $50 gain, and you'll pay capital gains tax on that. Now, sometimes if you're low income, your capital gains rate is 0%. you don't have any taxes. Most people fall into the 15% capital gains range for federal taxes. You can also have some capital gains tax on the state level. So depending on what state you're in, you can have some capital gains there. So that's the basics, and that's for any brokerage style account, joint investment account, any brokerage account that you have. What I want to focus on for Willie's question is I do think having a joint investment or a brokerage account is so very valuable and important. I feel like we've been the cheerleaders for this. Everybody talks about Roth IRAs. We're like the cheerleaders for brokerage accounts. And I think that's so important because having a brokerage account is like a backup to an emergency fund. And I hope that Willie uses the margin in his account, but has the security that if a second emergency hit, then you could tap into the brokerage account, right? Then you could tap into the Acorns account because it's there and it's available. But try to build up with your monthly margin, utilizing that to get your emergency fund back to the place it should be at, 3 to 6 months of expenses. And at the same time, you have a backup to that emergency fund in your brokerage account. We talk all the time. That's the flexibility bucket. That's having hopefully a goal with that money. Hopefully there's a target for what that money is going to do. But if you have 2 emergencies that stack on top of each other, then at least you have a backup to it. But I wouldn't feel really eager and concerned about, oh, I just tapped into my emergency fund. Now it's only 1 month of expenses. I should go ahead and take my 2 months out and replenish it immediately because that money is liquid. It's available. It's liquid. You can sell it at any time. You will pay probably a little bit of taxes on it, but you can get at it easily. So I wouldn't be too eager to jump right in and take that money out immediately.
You know, and I'm with you, and I don't want to discredit, though, the psychology because I've been there, and it's like you see this one side moving up and down, and you know that it's accessible, and you know that it's part of your emergency fund, but it would be a lot nicer if you just had it over here and forgot about it, right? And I get it because I'm very similar in that way. It makes no sense with our portfolio for me to allocate a Christmas fund. Like I've talked about that as part of our monthly budget allocation. Part of it goes into an account in accrual for Christmas. Makes no sense. Like we don't need to truly do that. However, I'd rather do that than come to the December time period when my wife says, hey, it's time to start buying gifts, and now I got to like sell something down to put it over there. It's annoying. Right. I don't want to do it. So I'd rather get it over there from a psychological standpoint. So I get it, Willie. Hopefully you found some value in those answers. Now you know the tax ramifications and the strategy. Bravo to you for following the DIY Money steps, though. It's going to obviously serve you well and continue to do so. Thanks for sending that question in. We'll send you a $25 Amazon gift card. And remember, friends, the secret to wealth is pretty simple. Live on less than you make, invest the rest, and do so for a very long time. Make it a great one.